Hey, everybody, welcome back to Beer and Money. My name is Alex Collins, and today is the third installment of To Roth or Not to Roth. Today, we're going to be talking about conversions. We touched on this real briefly in episode 2 when we are talking about how to go ahead and get money into the Roth structure and concept. Today, we're going to talk a lot about when to convert, what the tax implications are, what the strategies are, and why we may want to go ahead and choose to do conversions. So buckle up. This one gets into a little bit of nuance and detail. As always, make sure that you're consulting your tax advisor before implementing any of these strategies. This is not designed to be a recommendation to do any of these things. It is purely designed to give you information and knowledge around what is going on, when, why, and how you may want to implement some of these strategies. Make sure that you are working with good professionals, good tax advisor, good financial planner, and that they are on the same page before embarking on these strategies. So let's dive in. We talked about conversions. The main types of conversions that we're talking about here are going from traditional IRA to Roth IRA or non-deductible traditional IRA to Roth IRA. The other type that we're talking about is going from either after-tax contributions or pre-tax contributions inside of your 401k over to Roth. So what does this actually mean? What we are doing is with non-deductible or after-tax contributions, these are dollars where whatever we originally contributed, moving that from that style of account over to Roth, the principal is going to be non-taxable because it's dollars that we've already paid taxes on. Whatever the growth is, we're going to have to pay taxes when it gets converted. So typically the strategy winds up being to make the contribution and then immediately convert. That way we have very little to no appreciation. We want all of the appreciation to be in the Roth account because in theory, that's going to wind up making it so that none of those dollars get taxed ever again. There are ways to go ahead and mess that up. So it is possible for those dollars to get taxed down the road. And they won't be unless you break the rules around Roth 401k or Roth IRA. Make sure you're consulting your tax advisor prior to doing anything there. But again, it gives you an idea as to, okay, what we're doing is we're taking after tax dollars and making it so that it's tax-free dollars in the future. That's a really good thing. The next component to that is when we're taking pre-tax dollars and converting it to Roth. That's maybe a little bit more common or more commonly discussed. This is where we're changing the taxation of it. Every dollar that we do this with, whether it's original contribution or growth, is going to be shown as taxable income in the year that it gets ported over. We don't have to convert 100%. We can do a portion of it, so we can pick and choose how much we're doing in any given year. This allows us a tremendous amount of flexibility and freedom. And when you have flexibility and freedom, it's important to know when, why, and how we're going to go ahead and accomplish these things. How is relatively easy. It's paperwork to go ahead and get it converted. That's dependent upon whether it's an IRA or 401k. We need to make sure if it's in 401k that your 401k can accomplish that. Not all plans have access to conversions. So double check with your plan administrator prior to trying to accomplish this. The why. This is talking about like, okay, when would we want to do this? Well, whenever we're in a relatively low tax environment. That could be that the federal government has passed tax breaks. It could be that our income is lower this year for whatever reason. So if we're taking a sabbatical year, well, our income might drop to zero because we're living off of savings. It might be, or we're living off of income from our investment portfolio. Those things are going to wind up being lower tax years in general. That's a good thing. And that's a reason why we may want to choose to convert. If we've got a variable income, we're commission based, or we've got a small business and so our income goes up and down. If we've got high deductions or low income in any given year, well, that would be a year in which it's advantageous to go ahead and show a little bit extra income and convert at a lower tax rate. We need to make sure that we're taking a look at it. We need to get a sense of like, okay, when, why, and how are we going through this? So one of the things that's important to understand is it's important to understand like, okay, what is what's our income level and what has that done historically? There's some great websites out there that talk about what your income would have been throughout the years. If you want access to that, go ahead and shoot Ryan or I an email, head over to beerandmoney.net, drop us a line there and just say, hey, I'd like to go ahead and get access to it. I'll make sure that we go ahead and put a link in the show notes to go ahead and give you guys access to how to take a look at income over time and what tax bracket that would have been, assuming inflation and assuming what tax rates were. And we can go quite a ways back in terms of like showing what an income would have been and what what the taxes would have been for that level of income based on inflation here in the US. So it gives us an idea, but one of the things that we should understand is that typically we don't wind up passing our retirement income level until we're somewhere in our mid to maybe even late 50s. What that means is that we're going to be in the same or lower tax bracket until that point. Now, everyone's calculation winds up being a little bit different, depends on our career trajectory, our income trajectory. When like professional athlete, that number is going to be way earlier. They're going to max out in their mid to late 20s, or maybe even 30s, depending upon how successful they are. However, the average professional doesn't hit that crossover point to where they're going to wind up being in the same tax bracket in retirement, or same income level in retirement as what they are right now in their working years until their mid to late 50s. This is massively important of a concept to understand because so many people think, I'm going to be in a lower tax bracket in retirement. I won't be working. Well, Social Security is up to 85% taxable. If you have a pension, that is going to be 100% taxable. Most of your all of your traditional 401k money that comes out, that's going to be 100% taxable. Depending upon where your income streams are coming from, a lot of folks wind up having most of, if not all of their income or their cash flow coming from taxable sources. So while there's this concept and thought of, I'm not going to be working, I'll be in a lower tax bracket, that may not be true. And for just about all of our successful clients, unless they have done a tremendous amount of tax planning, it typically isn't true. We're going to be in the same or higher tax bracket in retirement because we're oftentimes going to lose our tax deductions like our house, our kids, things of that nature, our business, things of that nature. And so as a result, we wind up in the same or higher tax bracket. So that's some of the why behind it. And now, okay, when we start looking at these things, the next thing that we need to do is we need to go through a calculation and say, okay, well, what does retirement look like if we do this? What does retirement look like if we don't do this? Where's money going to come from? What are the tax ramifications? And try and map it out. Anytime we're mapping something out, we're looking 20, 30, 40 years in the future, we're going to get it wrong. Period. End of story. Our goal is to get as close as possible given reasonable expectations. And given that, we won't know what's going to happen with taxes. And so, again, it's our best estimate. But we need to go through that exercise to try and get a sense of like, okay, if things work out the way in which we expect, what will it look like? So that's step one. Step two is we need to understand the cost. If we're doing a conversion, is there a cost today? If so, what is it? There's usually two different costs that we need to look at. One is relatively nominal. That's the transaction cost. This is typically like $50, $100, something really relatively nominal. It should not impact this calculation much. The second component is if we're taking pre-tax dollars and turning it into post-tax dollars, we're going to have to pay money on whatever, or pay taxes on whatever that amount is. So for example, if we're paying taxes at a marginal rate of 20%, I'm picking a tax rate that doesn't exist, but the math is easy to do, and we convert 10 grand, well, our tax bill is going to go up by 2 grand. If we got a tax refund last year of 2 grand, that simply means that we don't, and everything's the same, we don't wind up getting that tax refund. We owe zero, we get back zero. It's still 2 grand that's out of our pocket that we otherwise would have had. So we need to make sure we're accounting for it. And it's important to know, the biggest thing that we need to do with this is understand what that tax bill is going to be and understand how we are going to pay for it. Because the last thing in the world that we want to do is, let's say instead of doing 10 grand, we did 100 grand. And so now our tax, if we had a 2 grand refund, now instead of getting a 2 grand refund, we're going to wind up owing 18 grand. Assuming that that's the only change that occurs. We need to know where that 18 grand is coming from, and we need to start doing some analysis on, okay, what else could that 18 grand have done for us? So again, that gives us a pretty good idea as to what, when, why. And the last thing that we need to do is, if we're doing this as we get closer and closer to retirement, there are some unintended consequences. When we get close to Medicare has this thing called IRMA, IRMAA. And if we go above certain limits, then we have to pay more for our Medicare. We need to be aware of this when we're doing conversions at or near retirement, because it might affect our IRMA calculation, which might affect how much we're paying for Medicare. Again, work with a professional, make sure you're working with a tax advisor, make sure you're working with a financial planner who understands this stuff. And if you just bring up IRMA and they look at you like, I have no idea what you're talking about, that's probably not the person that you want to be talking to, because you might wind up with some fairly significant unintended consequences. Hopefully all of this was helpful information. If it brought up more questions, please head on over to beerandmoney.net, drop Ryan and I an email or a note that says, hey, I have more questions. We'll either turn it into another podcast, or we'll reach out directly and help answer those questions for you. As always, we hope this information was valuable and hope you enjoyed Beer and Money. Cheers. Till next week. Bye.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklow, CA Insurance License number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7843105.1. Expiration date April 2027.